Well, good evening, everybody, and welcome to the June 2022 Roundtable. My name is Mark Robertson, and I am joined here by Ken Kavula and Ann Manning. Say hello, guys.
Hello, guys. Hello, everybody. So happy to be with you this evening.
And you need to give us a y'all.
I have to give you a y'all. Really? Yeah, I actually had somebody there tell me that even though I lived in Texas, he figured out since I went to Auburn that I definitely had an Alabama accent.
In Alabama, is there a difference? And I wouldn't
Yes.
be able to tell the difference at all. But evidently, you folks
Every
can.
state has their own accent.
They do. All right.
Oh, yeah.
Well, and
So
people,
do I sound like an Ohioan and Mark sound like a Michigander? Do we sound different?
You sound different, but I couldn't tell you where you were from.
Oh, mine's Ohio. Mark's Michigan's, or Mark's Illinois. Mark's from Illinois accent.
I every once in a while get accused of Chicago. And of course, that other Southern accent that many of you love so dearly, Cy Lynch, he's unable to join us tonight. He's dealing with family matters back in Georgia, and we absolutely send thoughts and prayers his way. As Ken said before, both Cy and his wife Barb are fine, but they do have a situation that he's dealing with. So he sends his best regards, and we'll pray for them. All right, so tonight's program is basically a little bit of a repeat, but as you're going to discover, it's not the same. And the reason it's not the same will become apparent as soon as Ken recovers and admits his guilt in the matter.
I will tell the audience that it's impossible for even the same group of knights and damsels to do the same program twice. It just wouldn't be in our nature to do it that way, Mark.
Absolutely. We had a great time in Dallas. We had as good a time as Billy Crystal did with Jack Palance, that's for sure. And we hope that there will be another one next year in a place that we can see the audiences continue to grow and have some fun. But let's go ahead and get underway tonight. Got an ambitious program. And let's see what we can do. No investment recommendation is intended. You guys all know this. This is about education. It's about taking and demonstrating the principles, methods, and techniques of the modern investment club movement. We're basically just illustrating. So anything that we talk about tonight, it will be our opinions, our approach, but we're basically sharing a time-honored approach to analyzing a stock that may have a few wrinkles that are different, but it's basically been the same for 70 or 80 years. So you'll see our opinions. Please do your own homework before making any investment decision. If we own something, we'll try to remember to disclose that. Many of you received a reminder. Natalie Kavula sends out a reminder per month about these monthly webcasts. We are coming up on our 12th birthday, beginning our 13th year next month. And if you'd like to be added, or someone you know be added to the reminder list, nkavula1@comcast.net. If you'd like copies of the slides, or if you have follow-up issues or questions, our two addresses are there, Mark R. at manifestinvesting.com and kavula1@comcast.net. Send all complaints about any endangered animals or that sort of thing to kavula1@comcast.net.
And all the compliments to Mark Robertson, right, Mark? Okay.
Absolutely. It'll be a tidal wave.
All right.
All right, here's our standing agenda. You guys all know the drill. Pretty much a similar format. First of all, welcome if you're here new. We keep here for the first time. We keep it fairly informal. You can communicate with us through the text box. And if you have audio equipment, especially at the end when we do the open Q&A, use your microphone. We'd love to hear from you. We keep track of our performance. We'll cover that quickly. We will not have any real portfolio management stuff because we already sold the Facebook and Meta the other day. The 5 stocks which will be presented are listed there. Green Brick Partners, Align Technology, MKS Instruments. We're just going to cover Cy's presentation. It's like a 18-time selection by Cy for the roundtable, so you guys all are familiar with that one. Ken Kavula and his love affair, more to follow on that, with AMD. And then we are going to toss a 10th selection of ARDX onto the pile. We'll do a poll at the end. Even if you're new here, you're welcome to vote. From Chicago, you're eligible to vote at least 3 times, especially if you're voting for my stock. So let's go ahead and get underway.
He's
Anything else
already
you'd like to
started.
do? Did you roll onto the floor, Ken, or are you okay?
No, I'm still here. Are you ready for me to do something? I'm not quite sure where we are. There we
Okay.
go.
Okay, we are here. This is just a quick summary. We are here just to share a favorite actionable investment opportunity in the study of that opportunity. We keep track of how well we do in a tracking portfolio, and our long-term return, we hope to be 5 percentage points better than the Wilshire 5000. We'll take a look at that. We would like to see the majority of our selections actually outperform the Wilshire 5000. So let's go ahead. We don't need another drum roll. Don't want to pay the union dues. Here's a look at our performance over time. We graph the relative return. The relative return is simply the actual annualized rate of return measured just like you would for any investment club, including cash flows, versus the Wilshire 5000. Again, matching or mirroring investments into the Wilshire 5000. And you can see that we have returned to the land of greater than 5% and 5 percentage points, and we're actually hovering above 6. We would really like to stay there, or perhaps even do better. So a little bit of applause and gratefulness for where we're at. And we actually are up to an outperformance accuracy that almost 52% of our picks are now outperforming the market, even in this extremely challenging market. And I don't know, Ken, I think maybe the gains made in some of the value stocks is kind of what's behind that nice trend on the right-hand side of that graph.
Well, what I really like about this slide, Mark, is that it not only shows our performance, but it goes back and it kind of points to the wisdom of George Nicholson way back in the 40s, when Mr. Nicholson said, you know, a good investment club should be able to turn out returns of about 15% a year, give or take a little bit. And he based that on the fact that at his time in doing the work in the 1940s, the long-term average of the market was around 9.5, 10.5%, depending on which of the benchmarks you use to measure the market. And here we are, almost 80 years later, still looking at the market as a whole and still looking at long-term averages. That relative return for the Wilshire 5000 is going on to its 12th year now. 12 of the more recent years that have certainly been very volatile, and yet check out the average, just around 10%, in this case 9.7%. So this is a slide that I'm beginning to use not only to show how well the roundtable does, but to show how accurate that idea of 10% return coming from the market as a whole over time, how accurate that really was back in the 40s and how it continues to be an accurate number today.
Absolutely. Let's go ahead and keep crunching on. Here's a look at the top 20 holdings in the tracking portfolio from largest by percent of total assets. That's this column right here. So or by basically value. So the way that you decode this is you take a look at Microsoft, for example. We take and invest $1,000 every single time that either a knight or a damsel or the audience selects any one of these stocks. So $5,000 has been invested in Microsoft. It is now worth almost $68,000, which is pretty cool. And so from top to bottom, you can see now these are just the top 20 by value. You can look at the entire list if you go to that dashboard down at the bottom, or excuse me, that link URL down at the bottom. That is a public link. You do not need to be a subscriber at Manifest to see that. You can follow along if you'd like there.
And we always like to point out our Costco holding down there, about 2/3 of the way down the list. And that Costco holding, Costco was only chosen once, chosen by our dear friend Hugh McManus back in St. Louis, I think it was. He chose it one time, and today that one-time choice is worth $10,167 and change. That's a pretty decent return, no matter if you're looking at 2 years or 5 years or 10 years or 12 years. 10,000 plus on a $1,000 investment is a pretty nice appreciation going forward. Our only regret is that we didn't mimic what Hugh was doing back then and choose it 5 or 6 or 7 or 8 more times during that period.
Yeah, I'd likely be up there with Microsoft if we had.
Absolutely.
All right, it's good stuff. So you can check that out at your convenience. We'll go over here briefly through the type of selling consideration analysis that we do every month. Again, it's a little bit different. We're taking care of a tracking portfolio. We're going to be extra aggressive at selling things. If Cy was here, he wouldn't believe I just said that. So don't anybody tell him. But this is a ranking from the lowest projected return for the lowest 5 projected returns, just in case any one of these jumps off the page as a potential sell candidate. Because by selling the lower return forecasts and then adding some of the higher return forecasts like we will tonight, we can actually boost that overall portfolio par, which right now is just a little bit below the sweet spot. We'd like to chase that 17.3 if we can, and we just continually attempt to march towards that condition. So that's the first criteria. Anything here that bothers you?
Yeah, our language has changed a little bit in the last 6 months about selling. Not the overall language, not the concept, but the numbers have changed a little bit. We always have advised that you don't sell a company unless you really need to, unless its overall par value moves down around what you can generate from cash. And we've been talking for most of the roundtable's history of cash generating less than 1%. Well, I actually think in the last 3 or 4 months, cash has begun to generate maybe 2%. So as these numbers move lower, I think we have a new low end target, but it's still quite a ways away from any of these par values.
Yeah, and one of the points that we made in Dallas is that the reason that the 15% that you see here, the overall weighted average projected annual return for the portfolio, the reason it's difficult to stay up with or ahead of that 17.3 is because our stocks are doing so well. So it becomes a very nice problem to have.
And I would suggest, Mark, that any investment club out there or any individual keeping track of their overall annualized return would be extremely pleased with a 15% return year over year over year over year.
Mm-hmm.
I know that I'm much less concerned about the par at 15 with the sweet spot at 17 than I used to be when the sweet spot was down around 11 and the par was down around 9. I had much more motivation to want to try to catch that sweet spot when the sweet spot was much lower.
Okay, let's go ahead. The second condition we look at is we take a look at how the company has done versus the market. In other words, relative to the market. And anytime it falls more than 20 percentage points behind, it basically falls into the timeout / do a sell consideration. And we basically made the decision in Dallas that we were tired of scratching our head about Facebook or Meta. So that we kind of picked that one away now. Everybody says, well, what about all the ARDXs? That's a special situation that I will protect from the castle wall against any invading nomadic barbarians.
It might even be labeled irrational hope, I'm not sure, but it's such a small percentage of the total portfolio that it's probably not tipping us one way or the other at the particular moment we're looking at it.
Well, we didn't sell it, when we might have, and we have a situation here where $1,000 has become 54, so it's kind of like, oh well. Boston Beer does make this list. I'm not going to talk anymore about Boston Beer. You guys are already concerned. All right. Anything else on this one, Ken?
No, I think we've paired it pretty well for the moment. The only one that we might have some discussion about going forward, Mark, is that PayPal holding.
Mm-hmm.
We've made all kinds of excuses. We've talked all kinds of reasons why PayPal might be underperforming, and we've held out hope now for quite a while, and it still continues to underperform. So maybe next month or the month after, if it's still there, we'll focus in on that PayPal. But for the moment, it's a single holding, and again, a very small piece of the total portfolio.
And one of the things I will point out is that Ann is with us here tonight because you don't find Manning on this list very often. When she picks a stock, it doesn't end up here very often. So we like that. So thank you, Ann.
You're welcome.
Yeah, I think the only person to beat her with this not on the list idea is Lynch, you know?
Yeah, they're both irritating with those southern accents and the fact that they really pick stocks well, but we love
Yeah.
it. All right, the last thing we look at is for hot stocks that could be giving us the opportunity to sell. It actually works both ways. In this case, we are watching for a stock. In this case, Ollie's, if you haven't noticed, has actually been red hot for the last couple of months, and it's shot up quite a bit, and it has triggered pretty close to a relative strength index of 70. We like to see 80. It's actually above 70. If you don't know anything about that, I would urge you to go to where that chart at the top came from. It's from their training, their chart school. Go to, and this is straight from the lips of Ralph Acambora, who was in Dallas. Go to stockcharts.com, and you can actually enter into the search box relative strength index, and you'll be taken to a really nice tutorial on how to regard it and what to watch for, what it means. And what it means here is just simply it's been red hot. There's a pretty good chance it could cool off, especially if it breaks back down below 70 on that top line, relative strength index. And it's just something you want to be aware of in your portfolios. Again, watching for the opportunities to perhaps partially sell or completely sell a position.
Yeah, that price scale is a little bit difficult to read, but you really should take a look at that scale off to the right-hand side of the graph. That low back in near the end of May was down around 40, and it's sitting around 63 right now. So that's a pretty decent return no matter what the stock happens to be, especially in this maybe 35, 40-day time period that we're looking at.
All right. So no actions really to take tonight. Here's a quicker look at the fundamentals associated with the company. You can see pretty much up straight and parallel, a little bit of a downdraft in 2021, 2022 when it comes to the profitability of their earnings. Nothing major, though, when complete stores were shutting down. And an awful lot of audience participants supported the notion that these guys are actually benefiting from some inventory offloading done by major brand stuff that actually ends up in Ollie's. And if you haven't been to an Ollie's, it really is an adventure. So it still continues to look fairly decent with a return in mid-single digits and a projected value which is in the 8 range also. So again, no rush to sell, just acknowledging that it has been pretty much red hot.
Yeah, we need to make it clear to a couple folks in our audience, Mark. We're getting a couple questions. Did you actually remove Meta? That's the old Facebook from the tracking portfolio. And yes, at the convention, when we ran the roundtable, the decision from the 4 people that were there was to remove Meta, or actually freeze the Meta holdings and not let them move around anymore. So we froze Meta at a loss. Remember, that's the old Facebook, new ticker META, and we don't have any active holdings now in Meta. Maybe I'll come back with you 3 months from now and I'll ask you again what's not to like. But right now, there's not very much in my mind to like about that stock.
All right, and if you go to that tracking portfolio, that public dashboard, you'll find that Meta is no longer there. All right, quick commercial for our Tuesday sessions at 2 p.m. Bull sessions. They're free. You can find them listed under events at Manifest. And this one celebrated electric vehicles, golden apples, and just, well, JR is right there in the middle. Okay. Well, I'm going to go ahead and start. Are you okay with that, Ken?
I have no problems with you being first. It gives you one less thing to complain about, Mark. Okay.
That won't stop me from complaining because I sat there
Okay.
patiently in Dallas and just got kind of the door slammed in my face. My stock was never presented. Oh, the things I have to deal with. All right. Well, one of the things I wanted to make the audience aware of, um, especially Manifest Investing subscribers, we have made some enhancements to the screening tool, the stock screener at Manifest Investing. I would encourage you to check it out. We've actually added a filter which filters on the elements and characteristics of the triple play. You just click that button from no to yes, and it takes care of that for you. We've also added prove, the projected return on value, which is going to be very comparable to par. You can now search on that criteria also. Also, the relative strength index down there towards the bottom. One cautionary note, at least I think it's a temporary cautionary note, you will be looking at a recent relative strength. It could be a couple days old, never more than a week old, but that thing does move around a little bit, and it'll be real time or same day fairly soon. I don't know when, but it will be fairly soon. And the last one down there, you can sort on the core score. So if you're out there shopping for core holdings, and we've been using this notion of adding the financial strength and the earning stability to the quality, and then gauging that against a sum of 225, could be 240, 225 or 240, somewhere in there. It's up to your taste. But you can actually sort by that now. So have some fun with that. I actually used it here. I basically am using the concepts taught to us by George Nicholson to basically ask the question. We know that the triple play works pretty well when you're under enemy fire and a bearish market. And we certainly have some of those conditions, certainly in the smaller companies right now. So what I did is I went looking for companies that are potentially oversold, that have basically had their stock prices crushed, and you can measure that by RSI less than 30. So here it's a maximum RSI of 30. And then I clicked this just to make sure that the companies that are displayed are potential triple play qualifiers. Now Ken's going to actually explain that when he presents his stock. And you can see here's the RSIs, and they are in the 20s. And basically go shopping here. So I'm looking down that list. I'm looking for something that's not too crazy. I want decent par. And then I'm also drawn to double digits here in growth, because I can pick from any of these, right? So double digit growth, good or excellent quality with decent return forecasts. So I end up liking Green Brick Partners. It happens to be a Dallas company, residential home construction. And so that's the one I go with. I did present.
Well, I think we should note, Mark, that list is really dynamic. That a week ago, MKS Instruments headed that triple play list, didn't it?
It did. Yeah, this one.
That's the only point I wanted to make. Nothing more profound than that. But it's a very dynamic list, so it pays to look at every couple of days rather than every couple of weeks.
Okay, now this is a timeout, a sidebar for those people that were in the Dallas audience when I picked Fresenius Medical. That's an old Saul Seinberg favorite, FMS. During the panel session, we displayed what looked like a pretty much. Did Pat Donnelly refer to it as Pennsylvania highways or?
Yes, that's exactly what he called it, right? A Pennsylvania road. Uh-huh.
So you got to remember that using the Morningstar data, it's not wrong, but it's basically as reported type stuff. And when you look at Fresenius through the prism of basically conditioned stuff like you would find in Value Line, the picture changes fairly dramatically. I mean, look at how steady this operating margin is here. And that's one of the more important characteristics. And it just looks a whole lot better out here than it did on the wall in Dallas. So study the differences. Study the difference. The audience laughed, Ken. The audience laughed at me.
Well, that was our job, Mark, to provide entertainment, okay?
All right.
And we didn't bother at whose expense it was provided. So
let's talk about Green Brick Partners, construction firm. I think of them, and this is my personal opinion, I think of them in the same type of approach to the business world as Warren Buffett and Berkshire Hathaway. They basically look for people who know what they're doing that seem to be quite exceptional in their field. So they're out there actually partnering and acquiring other construction firms around the country, and they have a real nice track record building with doing that successfully and integrating and maintaining the independence, but respecting, the total company approach and all that kind of stuff. So it's really a fascinating approach. Matt Spielman of Houston has presented this company a number of times in venues, and it's all over the Manifest Forum. He keeps track of it for us. And they started in Dallas, some fairly well-regarded construction firms as part of Green Brick Partners. And then they have begun to spread out into places like Florida, Georgia, and then most recently, Colorado. And they're going into these zones, which, I don't know, Ken, it's been a long time since I saw that kind of construction. When we drove into Dallas, man, oh man, some real construction going on there. The same is true in the Space Coast and northern parts of Florida. I'm sure the southern parts of Florida. Atlanta is one of the more prosperous construction zones right now also. And you can add Colorado to that list. And some pretty nice properties being built along with people who can afford to own them in those key areas of the country. Here's the other thing that's actually taking place. This has been a little bit impacted by the change in interest rates, but probably not too bad over the long term once we settle in. It's basically looking at the number of millennials that are willing to buy homes or eligible to buy homes these days. And you can see that that uptick on the right is going to put some demand pressure. They're going to want to buy some homes in the not too distant future. It's already a work in progress. The other way to look at that same type of thing, and again, these are Green Brick Partners slides from their investor presentation. This one is pretty important too. When you look at the inventory going all the way back to 1984, you can see that the inventory of existing homes that can be bought is basically tapered way down to all-time lows. And then the amount of new inventory, which of course was greatly impacted by what happened with COVID, you basically have a situation where there's a lot of demand out there, not expected to go away anytime soon, and not a whole lot of inventory to serve it. So it's basically a seller's market when it comes to that type of stuff. Here's a look at their fundamentals. You can see that this is about as up, straight, and parallel as this type of company can get. They're going to be subject to economic waves, and they seem to weather the waves pretty well. Notice that the operating margin has been gently increasing, as has the net margin, and it seems to be plateauing at a very nice area. If they can maintain that over the long term, those lines up at the top, based on what I just said about surging demand and certainly a steady demand over the next several years, you've got some pretty nice numbers here. A 30% par that's backed up by a 33% prove. That's all pretty good, fairly high quality. And we're only assuming a 14% growth rate, 13% net margin. Those are both viable. And we end up with $8 in earnings out in the 3 to 5 year time frame. This is just an interesting story. Very little debt. They do capitalize some debt, so it's better to actually track this company when it comes to total liabilities. I won't belabor the subject. We'll come back to that in the future. But this company is trading relatively close to its 52-week low, and its relative strength index is actually down here pretty good also. So I'm going to throw another helping of Green Brick Partners on the pile and hope for the best.
And all of this, Mark, for how often do you see a consistent grower at a less than 10 PE? You just don't see a high quality, consistent growing company at less than 10 PE very often. And Green Brick is very characteristic of a lot of these really high quality home builders. So I know I'm giving ammunition to my competition, but I really think this is a fine choice for the future.
All right. So with that, let's go ahead and turn to Ann. Ann brought back a company that's been a community favorite for some time. It took off like a rocket, and it's been bouncing around, but Ann seems to think it's time to take another look at this one.
Good evening, everyone. I just want to say, if you ever get a chance to go to Bink, it's near you, be sure to do it. It's well worth your time and money to do it. It's amazing what you'll learn. I've been to a lot of education deals, but that's my third bank, and I really, really enjoyed it. So anyway, take a look if you ever get the chance. I chose Align Technology to study. It's been on my radar screen for a little while, but I just haven't ever taken the time to study it. It's in the healthcare sector, and it's in the medical devices industry. And I'm sure you may have heard of Invisalign. That's the name of their product that's used by orthodontists and dentists. I'm going to give you just a little background history in the company so you can see how far they've come in a short amount of time. It was founded in 1997 by 2 MBA students from Stanford University, along with 3 other people. And one of those students just had some orthodontic work done, and at the end of getting his braces off, of course, they gave him the retainer, and he has more vision than I do. He was like, you know, what if we just take a retainer and just straighten teeth just using a retainer? So that's where the idea came from. They had a really simple concept: how to leverage technology to straighten teeth. What's even more amazing is neither one of these students had any orthodontic credentials or expertise. Needless to say, the orthodontists were really skeptical at first. They were, like I said, they were founded in 1997, and in 1998, the FDA approved their system, and they began their sales in 1999. They raised $140 million in funding from 1997 to 2000. And in 2000, they did a $31 million television advertising campaign. It was the most aggressive consumer advertising plan that the dental profession had ever seen. In 2001, they had an IPO, and they raised additional $130 million. In the early 2000s, most of their revenue was spent on marketing and advertising. This was so radical from regular braces, they had to get the word out what they were doing. Their co-founder stepped down from the management in 2001, and they hired a new CEO. They became profitable for the first time in 2003. Remember, they only started selling in 1999. In 2005, Harvard School of Dental Medicine began requiring all of its orthodontic graduate students to complete the Invisalign certification before they could graduate. This was just 8 years after the company was founded. And in 2007, the Academy of Dentistry approved Align Technology's program for continuing education. Next slide. As you can see, they have headquarter offices all over the world. Their support, software engineering, and administrative functions are done in California. Their aligners are manufactured in Mexico, and the treatment plans are created in Costa Rica. They provide the training and the certification to the doctors. Next slide. I'm just going to make this, I had several slides telling you about this. I'm going to just make this real easy, exactly how this works. They developed a special scanner that takes a 3D image of your teeth. And they do this for both teenagers and adults. And that image is then put into their software program that they developed. And that software program looks at your image, and it comes up with a plan for an aligner for every week that you're going to be wearing these. And most people average around 12 months doing this. What's really interesting is they do, you get every aligner you're going to have for 12 months. When you walk in, you know, go back and get them, because they figured out how to move each tooth each week, which I don't know how they do that, but that's technology. So, and then they've also come up with this thing. It's called, let me think here. It is called bite ramps, and it's kind of similar to something like a brace bracket, but the software tells the orthodontist or dentist what tooth to put it on, and it's not put on every tooth. It's just certain teeth, and they also tell them where on the tooth to put it, and that helps with moving the teeth. Again, I don't understand, and then you put the aligner over that so you don't see it. I will tell you that my granddaughter used this last year for 11 months. They need to straighten her teeth, and she had a bite issue, and she's done great. She just wears a retainer at night now, and her teeth look great. Okay, next slide. I mean, you're going to skip 3 of them, I think. Okay. If you remember, Harvard was the first one to accept their program. And you see here they have expanded their efforts to a lot more universities. They want to ensure that the doctors have consistent education and are Invisalign ready for when they graduate. At present, they have 124,000 doctors that actively use Invisalign. Next slide. They also award research grants every year to dental orthodontic students who are trying to come up with inventive ways to do things differently in the dental profession. And you can see here what they did in 2021. They also have a foundation that has contributed over $4.6 million to charitable causes. One of them is Operation Smile. That is a nonprofit doing cleft palate surgery. Another one is America's Tooth Fairy, which is a nonprofit dental clinic serving children. Next slide. This gives their first quarter of 2022 results. As you can see, they did $973.2 million. And guys, you need to tell me if I'm reading this wrong. I think I'm reading this right. At the present time, they only have 10% of the market. And 38% of that is adults, and they only have 5% of the teen market. So you can see they have a long way to go, and a lot more people that they can, use the Invisalign.
You're reading it right, Ann.
Okay, that's what I thought. I was just like, am I reading that right? So as you can see on the left, this is how they break down their revenue. I'm just not real sure what clear aligner non-case is. I've not been able to figure that out. But you can see, not only do they make money on the aligners, they make money on the equipment that they sell to the orthodontist and dentist to use their product. So, and their revenue geographically is about even in the Americas and the international. Okay, next slide. All right, these are the companies I came up with that were possible competitors. I mean, anytime you have a great product like Invisalign, you know people are going to try to copy you. Invisalign has over 1,400 patents, which I'm not quite sure how you do that on a little plastic thing. They did have some patents expire in 2017, but when you see the SSG, you'll see that doesn't seem to have made a dent in their sales. They are very aggressive in protecting their patents and technology. And if you look at this, you'll say, well, you know, they're kind of expensive, and they're kind of relative to the same as braces. But then if you look and see, it's most of the time it's half the time you have to wear it. Clearcorrect is a company. It's based in Switzerland, and they mostly operate in Europe. In the present time, they have a very small presence in the United States. Clearcorrect, I mean not Clearcorrect, Smile Direct Club has about 200 locations. They can do a scan if you come into their locations, but most of their business is done online, and they send you an impression kit. As you can see, they only cover mild to moderate cases. It's not considered a quality stock to own. Its stock covers around $1 a share. And Bytes is a privately owned company, which is completely online business. They will also send you an impression kit. Next slide. Okay, this slide, I hope it's not too confusing. The top chart on the SSG is if it just loads in on the SSG, and this is the results you get. And obviously in 2020, the sales and the profits dipped down. what I couldn't figure out was why did the earnings go way up? And what happened was, through much research, they got a really big tax refund from being overcharged that year. So in actuality, their earnings did go down with sales and profit, but it shows it differently. So the bottom deal is, I consider 2020 an outliner for them, and I took it out. So you can see they're up straight and parallel. I'm pretty conservative when I do SSGs. I picked 16% for sales and EPS. If you plug in the value line numbers, they chose 21%. Next slide. You can see the management does a really good job. If you take, again, that 2020 outlier out, you can see they're pretty consistent. If you go to section 3, you can see in 5 years, their stock went nuts. I mean, people were just buying it like crazy, which meant the PEs went way up. And now that the stock market has pulled back, I personally think they're where they should be. I think they just got way overvalued at the time. Okay, next slide. These are my evaluations, and I'm showing you what value line their high price would be. I thought 32 was a reasonable amount for the select high PE. And I personally always do 80% of the current price. I figured, you know, that's about the price of what if you consider a recession go down. So that's about all I'm willing to go down. So that's the reason I come up with 80%. I took a class from Cy at Bink, and he would shoot down my deal about using the price ranges, but for me, it still works. It is definitely in the buy range. Okay, next slide. And at the end, you can see value line came up with a 26.8% total return in 22.2, and mine more conservative is 20.2 and 13.6. Next slide. Okay, Mark changed this on me, but that's okay. This is Manifest equity page, and you can see it's a very high quality stock. It has a lot of room to grow, and pretty much everything about it is, I think, is really pretty good. So next slide. This is the Eagle from Manifest, and Mark was nice enough to plug some of the extra numbers in, and you'll see that the start price forecast is 642.58, and the projected return is 20.8. Next slide. And then I just put these together to show you you should be able to get a good return on your money if you're in this range. I will do some shameless promoting, as Mark says. I attended 2 classes that they mentioned a line. Their estimates were within this range. And I was told by other people there are 3 other classes mentioned a line. So there's my shameless promoting. And I just think, I hope I've given you a company of interest, and this is something you're wanting to do an SSG on. I'm sorry, I wasn't home this afternoon. I didn't see what the price was today. I know it's gone down. Last Friday it was $258.75, but I think it's gone down from there. But just hope you give this something that you consider and do an SSG for yourself. That's it.
Very cool. Thank you, Ann.
Thank you, Ann. I'm going to just really roughly go through Cy's. Cy has picked for maybe the 5th or 6th time MKS Instruments, ticker MKSI. You can see it has a fairly consistent sales growth line and a little bit bumpier earnings growth line, but No doubt about the trend of the line going in an upward direction. Remember that 2019, 2020, we had various COVID protocols in place, and that might have caused some issues with the company. But Cy likes to say that in general, he would name this up, straight, and parallel, even though it doesn't look as beautiful as some of them might look. Next slide, please.
Yeah, he's squinting when he does that.
Went at it, Cy likes to do a lot of different comparing of groups of stocks before he finally chooses a stock. So the first thing he did was he went to the tracking portfolio itself. That's the portfolio of stocks that we already own in the round table portfolio. And he noticed that near the dividing point between the top of the sweet spot, and that would be the DR Horton entry, and then the bottom of the companies that are actually above the sweet spot, MKS comes in really close to that top, and he feels that even with the orange background, that indicates it might be too good to be true. Cy felt that the 24.6 was absolutely believable, and I understand exactly where he's coming from, and I agree with him 100%. So he made his choice from the present tracking portfolio and then compared it to other companies in the scientific and technical instruments industry, and found that it was one of the higher quality stocks. And when you put quality along with par, MKS certainly stands out as the best in the group, with maybe one or two others being a close second. He then went, is this the next slide here, Mark?
Yeah, he sorts it by quality.
Oh, he sorts it by quality. So I already talked about that. So let's go on to the next slide. Here's what the company does. It's a leading manufacturer of a lot of small things that go into big products. Their original business was valves to control liquids and gases, and they still do a lot of that, but they do so much more than that now, and the company keeps adding different product categories and makes themselves more and more varied as the years go by. They're really focusing right now an awful lot on fiber optics and flat panel displays and lasers. So you can see they're trying to keep themselves right in the middle of the technology mix. Next slide. Here's products, a list of products, and there's that valves that they started out with as a company, and you can see they've added quite a few other things to it since then. Next slide. They're an industry leader. When you go through the different lists, you find that they're one or two in many, many sub-industries, and I think the next slide shows that.
But wait, we have to stop here because I think this really captures who they are and what they do.
Okay.
You may be familiar with the movie Disclosure. And
Okay.
maybe you're not, and if you're not, you should be, because Demi Moore's in it. And for the ladies out there, Michael Douglas, and there's some shenanigans that go around, but the plot revolves around a manufacturing facility that talks about all the stuff that these guys do. They basically take care of the environment and the atmosphere and all the tools and all that kind of stuff, because you have to have a very clean manufacturing environment, and Demi messes up. This is what I'm going to tell you.
So my question is,
Spoiler.
Mark, was that Cy or was that you on that slide?
I am taking editorial liberties.
That's what I thought. Okay, let's continue. All right. There's a lot of the different major subcategories they're involved with, and you can see how much of their business is devoted to separate subcategories. A majority of their business being done with semiconductors. Next slide, please. They're either one or two in an awful lot of markets. In 2015, they were the leading product in 7 of these subcategories, and that had gone up to 16 subcategories, more than doubled in a space of 6 years. You can see the robust growth rates of all the different markets that they happen to be in. Next slide. This just kind of breaks down what the different components are. And if you notice up in the little icons up there, it used to be just 1 or 2 icons to the left. You can see them there, the solar panels and the phones and tablets. And now that has grown quite a bit to add all kinds of other little icons, indicating they're getting into more and more and more businesses. 100 components per the kind of devices they were working with, let's say 6 or 7 years ago, and tens of thousands of components per device in the types of components they're working with today. Next slide. Lasers are becoming quite a something that you must have in manufacturing, and so MKS Solutions has moved into lasers in a big way. And again, you can see the difference between what they were doing in 2010 up to 2020. These slides are part of an investor presentation on the MKS website, and I would urge you, if you want to learn more about the company, to go to that investor presentation and review the whole presentation, not just the highlights that Cy has picked out. Next slide.
If he brings it back, I'm bringing that Michael character.
I figured you would.
Laser,
Okay.
lasers with air quotes.
MKS has not been particularly acquisitive over its history, but they are zeroing in right now on a company called Atotech or Autotech. I think it's Atotech, but don't hold me to it. It's a leading chemistry solutions provider, and it's going to fill a hole right in the middle of the products that MKS are aiming at. It's going to be accretive to earnings almost immediately, and it's a fairly large acquisition. So you're going to want to take that into account as you study the company. Next slide. The acquisition is said to optimize the interconnect. The places where the two businesses overlap is going to be particularly powerful, because MKS is going to contribute some of its patented materials to Atotech, and together the two of them are going to be able to create things that neither company would have been able to create on its own before the acquisition happened. Next slide. We're looking at some of the things that Atotech is positioned for. Next slide. And we're looking at some of the revenue that they're going to bring into the whole picture. Notice that we're going to go from 2.9 billion to 4.4 billion. So again, a pretty sizable acquisition is being made, and it's going to transform MKSI. Next slide. Sly has chosen to use the preferred procedure from his Better Investing SSG Plus, and he's altered, if you notice with the green circles, he's altered just a touch some of the numbers from the defaults. He feels the expenses have actually gone up a little bit from the 5-year average, and he's decided to leave the taxes basically the same by leaving the shares at the most current number of diluted shares, and it's just down slightly from the default number. Cy gets an EPS number of $13.82 per share, and that corresponds to about a 6% EPS growth rate. Next slide. By using that 6% EPS and assuming an 18 a forecast high PE, Cy is getting a par value of about 21%. By using a 13 times average PE value, he's getting a par value of about 14. Those are both much more conservative than the number coming from Manifest, which is based on analysts' opinions of 25. And Cy's statement was, I'm very comfortable with my numbers, and if there is a surprise, it looks like it probably will be to the upside, and that'll only make my numbers better than they are. He just thought that the analysts right now were a little bit over enthusiastic, so he takes it down quite a bit, but still feels it's a very, very suitable candidate for the roundtable portfolio. I think that's his last slide. Am I right, Mark?
Yeah, and I think the audience needs to imagine this guy in a southern accent walking around the room saying, "Who out there? How many of you have cell phones?" And he rattled off all these appliances, and of course everybody has them all. All right. Speaking of appliances,
So we're going to move into my presentation now, which is advanced micro devices. And I really do think this company is something to take a look at. Next slide. I start by showing you the visual analysis, showing you that the sales since about 2015 have been on a pretty great upward trajectory, and showing you how the company has climbed from being not profitable at all in 2015, 2016, or 2017 to moving into profitability, and then really moving into profitability and taking its earnings line up to be roughly parallel with the way the sales happen to be growing. I also put a big arrow right there about where Lisa Su actually becomes the CEO. She is a huge part of why this company has changed its performance so dramatically. She made it quite clear when she became CEO that her first job was going to be to beat Intel at its own game. If you used to look at the shelves in any electronics store and look at the laptop computers, you would see the ticket Intel inside. Today, that's just not true anymore. Today, you're more likely to have an AMD processor than you are to have an Intel processor, and Ms. Su has turned Intel into second in the industry. She's set her sights now on some other targets, and we're going to talk about those in just a moment. Next slide.
well, Ken, before we move on, I did think about playing the theme from Love Story in the background as you reviewed this slide. So
I deliberately didn't say that I thought I might be in love with a CEO because I was worried about what you were going to try to do, Mark. But let's move on to the next slide.
I figured
Okay.
that a hot picture might render you unconscious anyhow.
All right. I just think that this is a woman that is fearless, and I think it's a woman that knows exactly what it is she wants to accomplish with her company and what she needs to do to make it happen. She had the courage about 2 weeks ago to put up a new investor presentation as part of a whole series of presentations coming from AMD. This was her small portion to it. And it starts out by telling the world what she started as a 5-year plan in 2020. And you can see the 4 goals that she set for the company in 2020. She wanted to become an industry-leading IP company. She wanted to increase their standing in advanced tech, data center leadership, and especially in PC and gaming solutions. That was in 2020. Next slide, please. Well, here's the first slide that follows that immediately. She's already met her goal. That was a 5-year advancement plan. And here we are 2 years into the plan, and she's already the leader in data centers with best-in-class organic growth in everything concerning data centers. And then she spells it out on the slide. Next slide. And 2 years into her 5-year plan, she has become best in class in organic growth in PC leadership. That means materials going into PCs, laptops, and desktop versions, basically rendering IBM to be a distant second. Next slide. I said IBM, I meant Intel, excuse me. 2 years into a 5-year plan, she has become best in class organic growth in gaming leadership. And most of you can figure out who she has her eyes set on as a target. She has discussed, without naming the company by name, but she has discussed basically taking over the top chip in gaming, and that would be coming right now from NVIDIA. Next slide. Her revenue is first in class, moving from 6.7 billion in just at the end of 2019 to over 16.4 billion in 2021. Imagine that growth in just 2 years. See the compounded And see the A, that's for annualized compounded growth, 56%. Next slide. She's focused on strengthening the revenue mix. You can't really change your growth very much unless you move to higher margined products. And she's gone from about 15% on these really high margined data center products to make it about 25% of the mix 2 years later. That's a huge increase for any company. Next slide. She's also completed the acquisition of a very well-respected company, Xilinx. It was ticker XLNX, and Xilinx fills in the holes in many markets where AMD had no product of any kind. So you put these two together and you begin to create a giant in the field of chips. Next slide. You put the AMD along with the Xilinx and you increase your cloud opportunities exponentially, as well as your data center opportunities, and you allow AMD to move into automotive and embedded technologies where it had virtually no presence previously. Next slide. 2020, the adjustable market, the addressable market, about 79 billion for AMD all by itself. You add Xilinx sometime between 2020 and now, and that addressable market moves to $135 billion. And you look at the markets today, and this new company has addressable markets of about $300 billion. TAM, total addressable market. That means they have huge amounts of space to grow. Next slide. They're moving as quickly as they can, especially into PCs and gaming. They want to just become dominant right there, but they're also keeping their first, second, third place ratings in many of the mini categories associated with AI and, of course, with data center and the cloud. Data center and the cloud probably offers the largest opportunity for growth that the company sees across all of the different ideas. Next slide. Long-term financially, I've never seen a presentation where the CEO herself or himself was willing to go out on a limb and tell me what they anticipated earnings growth to be for the next 5 years. And here it is right here in AMD's report. They are projecting earnings at about 20% for each of the next 5 years. Now that's under the value line numbers for earnings or for revenues. So I've done an SSG that uses this number from the company as the basis of my SSG. I plugged in 20 for sales growth and 20 for earnings growth. Notice the numbers for management. She's moved debt from the high 70s and low 80s, and at one point debt was even 100% plus, and she's moved that down to 8% on the company, with return on equity, in territory that you just don't see in large companies. That 43.5% with very, very low debt is almost unbelievable. Her most recent pre-tax profit number is 22.3. That average is meaningless as this company intends to just keep on moving, and we have this huge acquisition that has taken place. Next slide. I didn't use the averages very much. I tempered them by moving away from 2017, 18, 19. I'm still looking at the bottom of the averages right there of 55.8 and 23. And I did decide that the 23 might be realistic enough at the low end, but I tempered the high end and dropped it to 40. I know that rising inflation, rising interest rates, they all lead to lower PE values. So by dropping it in this manner, I felt I was being realistic. And it's almost impossible to make this not a buy at the current price. The current price is a little bit higher than when this study was done. The study was done at $81.50 some odd cents. I think it's trading today somewhere maybe at $84, $85. I didn't get a closing market number. Next slide. There's a par value there of 20.9. I'm comparing it to a par value of 19.4 coming from Manifest. I love it when my two par values in Manifest and in Better Investing Tools end up being roughly the same number. It validates in both directions, and I'm certainly getting good validation for my study from my partner number in Manifest here. Next slide. Sales growth of 20%, par of 20% will both help our roundtable portfolio. It'll boost those numbers and they can use that boosting. I think this also qualifies as a triple play. I'm not sure this is the kind of triple play that Mr. Nicholson had in mind, but I think it's a lot cuter than the triple play that comes from up on a baseball field. Next slide.
Really resorting to a triplet future E-Trade babies, please.
Yes, yes, yes. Here's what a triple play is, folks. You're looking at a depressed stock price, and I interpret that, at least on a value line sheet, I interpret that as double-digit future returns. So I'm looking right here where it's circled at 25% at the high side, 13% at the low side. I think that indicates the stock price is depressed. And notice those numbers are based on an $87 price, $86.99 price at the top. We're looking right now at a stock that might be selling $3 or $4 under that price. The second leg of a triple play is the possibility of PE expansion. And I'm looking at a value line PE, which includes 2 past quarters and 2 future quarters at about 19. And then they're calling the PE out about 3 to 5 years from now at 29. So that certainly says expansion to my mind. The third leg of a triple play, we're looking for net margins to have the possibility to expand. And I'm looking at net margins that have gone from 3.4%. The most recent real net margin is 20.9. They're looking this year for 28.6. And 3 to 5 years from now at 27.3. That's certainly expansion from the last real number, although there might be a slight bit of net margin contraction from 2022 to the future. It looks again like they're predicting expansion from the 2023 number. All in all, triple play just means at the end of a possible bear market, these kind of stocks belong at the top of your to study list. They're not guaranteed slam dunks. They're just the most interesting stocks of the universe that probably you want to place near the top of your to-do list if you're studying a lot of stocks to add to your portfolio. Thanks a lot, Mark, and let's hear the next one.
All right, this is quick and dirty. We've selected ARDX 9 times. I think 7 by Hugh, 2 by me. I simply can't resist another 59 cents for another $1,000 worth of ARDX. So we're going to do it a 10th time. A lot of the selections we made were back in this circle. Hugh did have a couple back in this area here. The point that I'm making is we've told the story a number of times. These guys are attempting to come to market with a solution for kidney patients that will control the potassium, and they show pretty good tendencies and results. And about a year ago, and you can see from this, these are monthly price bars. This is where the FDA basically had that thought they were at the doorstep of approval, and the FDA said no. They've been appealing ever since then. They recently received notice that they would have a meeting here in a few months, so that's actually a promising sign. The other thing is that one of the individuals that seemed to be kind of a gatekeeper left the FDA and has been replaced by someone who has a little bit more positive track record with companies like this. So there is some hope. The other thing that continues to still be true, they have $2 or $1.50 to $2 in their checkbook, and it's selling for 59 cents. So that's all kind of neat. And we'll just throw another lot on the pile. I get 2 picks because I didn't have any in Dallas.
I hear the
Do we feel
violin.
sorry for him?
I hear the violins coming to a crescendo in the background. So let's launch the poll, okay?
Whip up the.
Here's our poll, folks. Vote for one of these. And if you want to vote for none of them, or if you want to put money into ARDX, you can vote for that 5th one if you choose. Mark wants to see how much pity vote is actually out there for him. So,
Really?
and we'd love to see about 90% of you voting. We're already up to almost 60% of you voting. It doesn't take anything, doesn't cost you anything except to move your mouse over the company you'd like to have. And if you're on a touch screen, I think you can vote using your finger on the screen. We're up to 80% voting. Let's try to give it maybe another 10 or 12 seconds. Let's try to push that up to 90 if we possibly can, because it'll give us a better indication of where our audience happens to be. 84%. Come on, folks, let's push through a few more votes here, okay? Vote for one of the 5 and help us out. There we go. We went up to 87%. So I'm going 88%. I'm going to close the poll.
Oh, that's my lucky number.
I'm going to share. It wasn't your lucky number, Mark.
Really?
And I'm going to share the results, and AMD will get another $1,000 added to it. It got 61% of the vote. MKS came in 2nd. Align came in 3rd, and Greenbic came in 4th. And our friend ARDX takes up the rear here with none of the above.
Well,
Go on, Mark, you going to file a challenge or what?
Can we add my 2 together? Does it help if I add them together?
Okay, I'll add them together. No, it doesn't help.
I like the poll at the Bink much better.
Ann is indicating that at Bink, we used raised hands, and it was extremely tight between Align Technology and Advanced Micro Devices. I guess I'd like to say we have a very discerning audience at the actual roundtable here. So thank you, folks, for.
Oh, right.
I hope that AMD comes through for all of us, because I actually own that stock. So I'm going to close the poll, Mark, and turn it back over to you here.
Okay. You better hope you never have to ride 17 hours with Ann.
I don't know if I'm ever going to ride 17 hours with anybody in the rest of my life, okay?
Could be. Here's just a quick reminder that we do archive all of these sessions on YouTube. If you just search on Manifest Investing in the search box, you will see a page very similar to this. We would invite you and basically beg you to subscribe. It's free. The only thing that will happen is you will be notified when new content is added. That new content could be roundtables, bull sessions, or special educational sessions. Haven't had a list like this in a while. Again, I honor the NAIC National Convention, which we just completed. All of us were a part of that. The roundtable will be on July 26th, and we are beginning to pile up some road trips. Indianapolis will be on August 6th. Mid-Michigan will be just short of Thanksgiving, and you will see other events filling in, whether they're virtual or we are actually on the road again. So, Ken, there could be a Punxsutawney in our future.
There could very well be a Punxsutawney in our future. Folks, that Indianapolis trip will be our first face-to-face in about 2.5 years. And if you're anywhere near Indianapolis, they put on quite a show. And we plan to have a great time with our audience right there. So if you can possibly make it to Indianapolis on August 6th, check out the Indianapolis. It's called the Indiana Chapter, the Greater Indiana Chapter. Check out their webpage and you'll get information on how to register for that particular event. I have a hand in the air. Judy, I'm going to unmute you. I'm not going to unmute you, Judy, because you're self-muted. So you'll have to unmute yourself and then we'll let you speak. Go on, Judy.
I think that you did show me the SSG, so I'm fine. Thank you.
Okay, great. Thank you. I do have a couple of questions here, Mark. So once we shut down, if we can keep things together, we'll make sure. Oh, I have a comment here from Marie Frank. And Marie says that the CEO of AMD, Ms. Sue, is very competitive. And here's a fact I didn't know. Her cousin is the CEO of NVIDIA. So a very talented family and a lot of competition evidently going on between the two CEOs.
Well, Ken, while you're drooling, were you aware that she has a big building named after her?
No, I'm not aware of that either.
I'll send you a picture if you'll send that pool picture to her.
No, I'm not going to.
All right. So with that, I think we can go ahead and shut down the recording of the event and take a few questions. But again, Jerry Pillins is on the broadcast along with several other members of the Better Investing Volunteer Advisory Board. Just want to say thank you and nice show, guys. Keep up the good work. And with that, better investing to everybody. And we'll shut down for the night, but we will stick around for a couple of questions.